Right now, millions of homeowners are trapped in their homes because they can't afford to give up their low interest rate. And the Trump administration just proposed a solution that sounds amazing on paper. But after working with thousands of clients, I can tell you why this might not be the home run everyone thinks it is. Hi, I'm John Wells, mortgage lender and branch manager with a decade of experience in the lending space. I've helped thousands of clients just like you achieve their goals while being budget and wealth conscious. So if that sounds good to you, let's get into the video. Now, before we go any further, quick disclaimer. This isn't financial advice, and I'm going to walk you through some very high-level concepts today. And I promise to do my best to communicate them effectively. So stick with me, because by the end of this video, you'll understand why this portable mortgage idea might actually break the entire system. So here's what we're covering today. I'm going to break down this portable mortgage idea, explain what it actually means for you, and show you the critical things that nobody else is talking about, including why banks might never allow this to happen. And by the end, you'll know exactly whether this benefits you or not. Plus, I'll share a real scenario with actual numbers that might surprise you. Now, before we dive in, if you're serious about qualifying for a home, fill out my free questionnaire to see just how home ready you are. I'll drop the link in the description below. Now, let's talk about what's happening. The news broke recently that the Trump administration is exploring something called portable mortgages. Sounds fancy, right? Well, here's what it actually means. Imagine you bought a house a few years ago, you locked in a 3 or a 4% interest rate, and now you want to move to a bigger home. But today's rates are sitting at 6 or 7%. That's a huge jump. Most people would look at that difference and say, nope, I'm staying put. And that's the problem. Homeowners are stuck. They can't move without losing their great interest rate. And that creates a massive bottleneck for the housing market. Fewer homes for sale means higher prices, fewer options, and buyers frustrated everywhere. So here's the proposed solution. What if you could take your low interest rate with you when you move? Imagine packing up your mortgage like it's a piece of furniture, and then you apply it to your next house. That's the portable mortgage solution in a nutshell. Now, I know what you're thinking. That sounds incredible, and yeah, on the surface it does. But here's where things get complicated. And this is where most people are going to get burned if they don't understand how this actually works. And more importantly, why the banks might never let this happen in the first place. So let me tell you about a client I worked with last year. Let's call her Sarah. Now, Sarah owned a home worth about $250,000. She'd been paying her mortgage down for years, and her current balance was down to about $146,000. And her rate? Well, it was a beautiful 3.5%. Now, she wanted to upgrade to a $400,000 home because her family was growing. And when she looked at current rates hovering around 6.5%, she felt stuck. Does that sound familiar? Now, if portable mortgages become a thing, Sarah's story would play out very differently, but not in the way you'd expect. And that's what we're about to unpack. Now, here's the first big thing you need to understand. If this portable mortgage idea becomes a reality, it almost certainly won't apply to loans that already exist. Now, I know that's disappointing because you're probably sitting there with a 2 or 3% mortgage thinking, well, great, I can finally move. But here's the reality. You already signed a promissory note, and that note has terms. And one of those terms is that that loan is tied to a specific property address. Changing that would require massive modifications to millions of existing loans, and the paperwork alone would be insane. And the legal challenges, well, they would be even worse. So what does that mean for you? Well, if you have a low rate right now, this new policy probably won't let you transfer it, and your golden ticket would stay locked to your current house. And that means that the housing market bottleneck, as I mentioned earlier, well, it's not going anywhere. People with great rates will still feel trapped, inventory will still be tight, and prices will stay high. Now, let's talk about the second thing, and this could be huge. Even if you could transfer your mortgage, you still have to bridge the gap. But here's where the math gets interesting. Let me explain what I mean. Let's go back to Sarah. She owns a $250,000 house with a $146,000 mortgage, and she wants to buy a $400,000 home. So she sells her house, and here's the key. She's not paying off that mortgage because she's taking it with her. That means that she'll pocket the entire $250,000 from the sale. So now she's got $250,000 in cash, plus she's bringing that $146,000 mortgage to the new property. So that's a total of $396,000 towards a $400,000 purchase. So she only needs $4,000 to cover the gap. Sounds perfect, right? Well, not quite. And here's what nobody's talking about. To get access to a portable mortgage feature, you'd almost certainly need to put down 20% initially and waive your escrows. That's the account where property taxes and home insurance get held. Managing escrows when a mortgage is moving from one property to another would be an absolute nightmare. So lenders would probably require you to handle your own taxes and insurance. That means that on a $400,000 purchase, you need $80,000 for your down payment, which equals out to 20%. Now, in this scenario, Sarah has way more than that, so she's good. But she'd also need to suspend her escrow account on the original loan if she had one. And not everyone's allowed to waive escrows. It really depends on your loan type and your lender. Now, here's where things get even more interesting. Let's say Sarah decides that she wants to move up to a bigger house. Let's say it's a $600,000 home. She sells her $250,000 home, keeps her $146,000 mortgage at 3.5%, and now she needs to come up with the additional 20% to go purchase on the new place, which is $120,000. Now again, she's got $250,000 in cash from the sale, so she's covered, but her total loan amount on the new house would be $480,000. And remember, she's only bringing $146,000 from her portable mortgage, and that leaves a gap of $334,000. So she would need a HELOC, which is a home equity line of credit, for the $334,000. Now, HELOC rates are also higher than first mortgage rates. We're talking about 2 to 3% more than the current market rate. So in this scenario, if the market rate's 6%, her HELOC might be 8 or even 9%. So let's run the real numbers. Her first mortgage is $146,000 at 3.5%. Her HELOC is for $334,000 at 8.5%. Now, I already ran this through a spreadsheet, so you don't have to, and here's what I found. Because her first mortgage has already been paid down for years, the amortization schedule is significantly more favorable. Most of her payment is going towards principal, not interest. And now that actually makes the portable mortgage option very competitive, even with a higher HELOC rate. But here's the catch. You likely need to match the loan terms of the HELOC with your existing portable mortgage. Most second lien holders never want to take first lien priority. So if your portable mortgage has 20 years left, your HELOC would likely need to be structured for 20 years as well. And that would change the monthly payment calculation and could make it less attractive. Now, if you're finding this video helpful and you want more content like this, please hit that subscribe button right now. I break down complex mortgage topics every single week to help you make smarter financial decisions. Now, here's where we get into the real reason why I don't think banks will actually allow portable mortgages to happen. And this is the stuff that most people aren't talking about because it's a little bit more complex, but I'm going to break it down for you. Reason number one is going to be property types. Every property has pricing adjustments based on the risk. These are fees based on the type of property you're purchasing. Is it a single family home, a condo, a manufactured home, or a multi-unit property? Each one has different risk profiles, and lenders would charge different rates or fees accordingly. So if you're moving your mortgage from a single family home to a condo, how would your lender account for that increased risk? Condo pricing typically comes at a premium because of HOA involvement and shared ownership structure. If your portable mortgage was priced for a single family home, the lender is now taking on more risk without being compensated for it. And that's a problem. And it's a complicated problem to solve. Do they adjust your rate mid-loan? Do they charge a fee? Do they just not allow it? Nobody really knows. And figuring that out on millions of loans could be a logistical nightmare. Now, reason number two, people would hold on to their mortgages for longer, and that would completely change how the mortgage industry works. Right now, the average mortgage only lasts about 7 to 12 years. People refinance, they move, they pay off the loan early, and that turnover is built into how mortgages are priced. Lenders and investors expect loans to be paid off or refinanced within that timeline. But if people are now allowed to take their mortgages with them, they're likely going to hold on to them for 20, 25, maybe even 30 years. And that changes everything. The relationship between mortgage rates and the 10-year Treasury yield is based on that assumption of holding for 7 to 12 years. If loans start lasting longer, and when that relationship breaks down, rates are going to go up because lenders now have to account for the increased risk and the longer duration. So ironically, portable mortgages could actually cause rates to stay elevated permanently. And reason number three, and this is a big one, bond values. When you get a mortgage, that loan doesn't just sit on the lender's books forever. It gets packaged up with other loans and sold to investors as mortgage-backed securities. These are what's called bonds, and those bonds were issued based on the assumption that your loan has a certain interest rate and a certain lifespan. Let's say an investor bought a bond backed by mortgages with 2 to 4% interest rates. They're earning that yield, But if interest rates rise to 6 or 7%, the value of that bond drops. And that's just how bonds work. When yields go up, values and prices go down. Now, if people can take those 2 to 4% mortgage rates with them and hold on to them forever, well, those bonds are going to lose even more value because the cash flow never increases. And now that investors stuck earning 2 to 4%, while the market's paying 6 to 7%. And that's a massive loss for bondholders. And if portable mortgages become a thing, you'd likely see rates elevated permanently because the cyclical nature of mortgage banking would grind to a halt. Investors would demand higher yields to compensate for the risk that these loans never get paid off early. And the whole system is built on turnover, so portable mortgages would destroy that. So here's personally what I think would happen. Banks are going to take one look at all of this: property type complications, the longer loan durations, the bond value losses, and they're just going to say, no thanks, this is too complicated. It's too risky and it's too disruptive to the entire industry. But let's say it does happen. Let's say they figure out a way to make it work. Here's what you would need to know as a borrower. If portable mortgages become a real option, they're probably going to be their own product type. Think of it like how adjustable rate mortgages and fixed rate mortgages are their own specific loan product with specific rules. Portable mortgages would likely work in the same way. And here's what that means for you. You'd probably have to pay extra for the privilege of portability. Maybe that's a higher interest rate up front, maybe it's a bigger origination fee, maybe it's both. Unfortunately, nothing in the banking world is free. If lenders are giving you the option to move your loan, they're probably going to charge you for that flexibility. And here's another wrinkle. This would likely only apply to conventional loans backed by Fannie Mae or Freddie Mac. FHA and VA loans probably won't apply. And why, you might ask? Because those loans are already assumable. That means that somebody else can take over your loan when they buy your house. It's a very similar concept, but it actually works in reverse. You're giving your rate to the buyer, not taking it with you. On top of everything we also talked about needing to waive your escrows, FHA and VA loans currently don't allow you to waive your escrows, which is why I think that portable mortgage options wouldn't actually apply to those types of loans. So if you're planning to use an FHA or a VA loan, this whole portable mortgage conversation might not even apply to you. And that's a big chunk of the market. Now, here's the thing that's going to shock you. Even if portable mortgages become available, they won't always make sense. In fact, there are going to be plenty of situations where you're just better off getting a brand new mortgage. Remember Sarah? Let's say that her mortgage balance is actually lower. Maybe she paid it down to $100,000 instead of $146,000. Now the gap that she needs to fill with the HELOC is going to be bigger. And if that HELOC rate is 9% or even a little bit higher, the blended rate on her two loans might actually be higher than if she just took out a single new mortgage rate at 6%. Plus, she could even buy that rate down to about 5.75% or even lower with points. Suddenly, that portable mortgage option will be costing her more money every single month. And this is what people are going to mess up. They're going to hear the portable mortgage option and think that automatically it's the best solution. But without running the numbers, they could end up paying thousands of dollars more over the life of their loan. And that brings me to my final point, the need for an advisor. It's more important now than ever. Mortgages aren't easy. I've been doing this for a decade, and I still see people making costly mistakes because they don't fully understand their options. With portable mortgages potentially entering the picture, the decision tree gets even more complex. You've got to consider things like your current rate, your current loan balance, how much you've paid down, the new property price, the gap you need to fill, HELOC rates, first mortgage rates, property type changes, escrow requirements, loan term matching, buy down options, your long-term financial goals, and how long you plan to stay in the home. That's 13 variables just off the rip. And if you get just one of them wrong, it could cost you tens of thousands of dollars. This isn't a decision you should be making based on a headline or even a quick Google search. You need someone who can run the real numbers, show you real scenarios, and help you understand what makes sense for your specific situation. And that's exactly what I do with every single one of my clients. We don't just close loans, we create a financial roadmap. We make sure that you're set up for success today and tomorrow. Because at the end of the day, your mortgage is one of the biggest financial decisions that you'll ever make. So it deserves more than a one-size-fits-all answer. Now, before we wrap it all up, I want to give you something actionable. I've created a free ROI on down payment calculator that shows you how different down payments will actually impact your return on investment over time. This is especially useful if you're trying to figure out how much to put down on your next home. If you want to grab it, the link's in the description below. Download it, Use it, it'll help you make smarter financial decisions. So let's do a quick recap. Portable mortgages are amazing, but they can come with some massive complications. Number one, they probably won't apply to existing loans, so your current low rate is likely stuck where it is. Number two, even though you keep all your sale proceeds, you'd still likely need 20% down and to waive escrows, which would complicate things. Number three, you'll still need a HELOC to bridge the gap between the equity you have and the purchase price. And you'd also have to match your loan terms, which might not work in your favor. Number four, property type changes would create huge complications with loan pricing adjustments. Number five, people holding onto loans longer would break the relationship between mortgages and treasury yields, causing rates to rise. Number six, bond values would crash because investors are stuck with low yielding securities, and that could keep rates elevated permanently. And number seven, the entire system is built on loan turnover, and portable mortgages would destroy that. So here's my question for you. Drop a comment below and tell me if portable mortgages become an option, would you actually use one? Or do you think the complications aren't worth it? I'm curious to see what you think, and I'll try to respond to as many comments as I can. And speaking of comments, let me answer a question I saw last week. Someone asked me that if they currently have a low rate, but they need to move for a job, what's the best option right now? And that's an amazing question I hear all the time. Right now, your best bet would be to keep your current home as a rental if possible. Lock in that low rate, let a tenant cover the mortgage, and then go get a new loan for your next property. And yes, you will have two mortgages, but if the rental income covers the first one, you're essentially keeping that low rate working for you. Just make sure the numbers work for you, and you qualify for both loans, and you have significant reserves to cover any delayed rent. Here's the bottom line. Portable mortgages are an interesting idea, and they could help some people in very specific situations, but they're not a magic solution. And they're probably not going to happen because of the complications are way too massive for banks and investors to accept. And even if they do happen, they're definitely not going to be the right choice for every single borrower. So you as a consumer need to understand how they work, run the numbers, and make a decision based on your goals, not just the headlines. Now, if you made it this far, you're clearly serious about making smart financial decisions. And that's exactly the kind of person that I love working with. Whether you're buying your first home, moving up, or refinancing, I'm here to help you figure out your best path forward. So if you're ready to talk with a professional, if you want to run your scenario past me, there's a link in the description below to book a free 15-minute consultation. And if you're ready to take that next step, there's also an application link there as well that you can fill out and get your free pre-approval or your refinance quote today. I'd be honored to have the opportunity to earn your trust and your business. And lastly, go ahead and like this video and hit the subscribe button, because if you liked this video, you'll love the next one. I'll see you there.